Callum, Executive Chairman at Exergy and Professor of Energy at Strathclyde University, Andy Lavin, CEO of Sahara Energy Resources, and last but certainly not least, Kate Durian, Meese Contributing Editor and Non-Resident Fellow at the Arab Gulf States Institute in Washington, D.C. Kate, welcome, and I'd like to start with you this morning. You published, and it's one of the articles on our news bulletin today, you published a piece in Meese yesterday, which said that OPEC may find itself between a rock and a hard place when it comes to shale oil and what's happening there with rising production. So would you say they're miscalculating again the advent of what's going to happen with shale volumes?
I don't think so. I mean, if you look at the IEA report that just came out, it was basically saying that, as the US recovers from hurricane, the impacts of the hurricane on production is rising, but it also sees that these prices, I mean, okay, today they've fallen below 80, but at these prices that US shale will actually grow. It won't come back to pre-COVID levels, but you have OPEC plus at the moment not really producing at the levels that they pledged to increase by 400,000 barrels a day because some members just can't keep up. So I think you're going to get this for a period at least until the market stabilizes. You're going to have increases in US shale. So that's a concern for Russia. It was on the back burner in 2020 because US shale was dropping. And even if it doesn't return to pre-COVID levels until the end of 2022, it's something that, again, I think has raised its head and may impact the sort of dynamics between the producers who need higher prices and those that, like Russia, which can actually sustain its economy on a slightly lower price than currently.
Yeah, but I mean, you're implying there that the US shale producers are kind of going to operate on whether OPEC can meet its quotas or not, i.e. the certain members, as you mentioned, who aren't currently meeting their quotas, and perhaps OPEC, there's arguments that they aren't making up for that, the members. But, is that the case? Or will US shale just look at its bottom line and its cost of production and it's coming back already? I mean, we're nearly at 12 million barrels. Why wouldn't it continue to produce at these prices regardless of what OPEC does?
Yeah, no, regardless of what OPEC does, I think it's price that's driving it. I mean, if you look at the Permian, I think it's mainly concentrated in the sort of, the big areas of Bakken, the Permian particularly, which I think reached a record recently. So I think it's just the price driving it, and it's OPEC policy that's driving this price because they're not responding to calls for more oil. But again, if you look at the numbers, everybody expects a surplus, whether it's the IEA, OPEC, or EIA. They all expect a surplus to emerge in early 2022, unless the demand forecast changes.
Okay, Andy, I mean, on that front of prices and EIA, as Kate just said, forecasting surplus as early as the first quarter. The market does seem pretty calm. And we had the severe winter storm on the west coast of Canada and British Columbia, and the oil markets don't seem to be too bothered. In fact, they've softened. So, is that argument of, well, demand is dropping and we're going to have plentiful of supply next year, has it settled into the market thinking?
I think we're still in this area of uncertainty as to whether we are going to be seeing a supply issue or a demand issue. And that's the challenge. So realistically, for the market to move, something has to happen. Something has to challenge the market's view in terms of where we are. And at the moment, you've basically got mixed messages. COVID could come back. Oh no, COVID could go away. Demand is falling, demand is dropping, demand is going up, supply is dropping. There's too much uncertainty. So therefore, we're just drifting along effectively.
And what do you make of the US's continuous plea to ask now, not just is it considering releasing from its own SPR, but, it's asked China last week or early this week, and it's calling on other countries, please, everyone, release more oil. I mean, that's, okay, domestic politics at play. But do you think that it's justified given that there is a shortage not coming from OPEC at the moment?
So to me, it is 99.99% domestic politics. No US president likes high gasoline prices. End of story. And they'll do whatever they can to keep gasoline prices low because that's what public opinion is all about. I think that we have, there is a double-edged sword. If prices stay long, high, then you will start to see kind of the shale oil coming back because it makes good business sense. You've made the investment, and why wouldn't you? But equally, if you start to continue to see underinvestment by the international oil companies, there will ultimately in the long term be a supply crunch. To me, all the short-termism in terms of whether we're going to see a supply demand or a supply crunch next year is indeterminate at this point in time. We really haven't got, the globe hasn't got itself back onto a solid footing so that any person can realistically say, this is a confident assumption for next year.
Okay, James, hi. Just talking about market confusion and uncertainty, how is the market meant to interpret Joe Biden's energy policy at the moment? Obviously he's asking OPEC to pump more oil. He's planned and already imposed certain restrictions on his own production industry. And yet yesterday we see this huge auction in the Gulf of Mexico, the government sort of, taking bids of $200 million for drilling rights. How confusing is that for markets?
Oh, look, it's incredibly confusing as a policy. I think the reality is that what we are witnessing is Biden trying to, if you like, navigate a middle path between stimulating the economy in the United States, dealing with inflation, whilst at the same time promoting a strong environmental policy coming out of the back of COP26. I totally agree with both Andy and Kate. I mean, the point which Andy makes around uncertainty, the point which Kate makes around, shale oil or sporadic production activity coming back into play as we come out the tail end of this year. The reality is that what we've witnessed over the course of the last couple of years in terms of, or what's been badged as capital discipline within the shale oil industry has really been shale oil producers bringing on stream drilled but uncompleted wells to take advantage of relatively high prices when they can, because to be honest with you, access to capital has become increasingly tight. And I think that's the big rhinoceros's head in the room for shale oil going forward, which is where are you going to get the money to actually drill new wells, not bring on existing drilled wells and recomplete them or complete them for the first time. Where are you going to get the capital to drill new wells? And clearly, we have seen the super majors pull away from that. And Ben Van Beurden has been very explicit about the fact that the Shell's move towards renewable energy has to come from revenues generated from hydrocarbon production in the short term. The reality here is Biden is trying to work out how to stimulate the US economy, how to keep down inflation, whilst at the same time actually exert the kind of pressure that he needs to exert to be an environmental champion. And it's confused at best.
And I mean, in terms of the immediate sort of, as you said, the undrilled, not the drilled wells, i.e. those that the shale producers are kind of going back to, has there been any impact there? Clearly not, because we're seeing the drilling going on, but from this shortage of labor, shortage of materials, the supply chain issues that we've had, there was some comments a few weeks ago that, you couldn't even get the right skilled workforce back to those shale deposits.
Yeah, I mean, there is a great deal of talk, if you like, around increased activity, but I think that needs to be put into context. Where if you take a look at the Baker Hughes rig index, it's at about a third to a half of its peak. Prior to COVID, and the reality is, if you take a look at the OSX index, which looks at all the stock prices of the major service companies, it's at almost 25% of its peak, and indeed is down almost 10% on the course of the last week. So if you take a look at that as a measure of activity out there, clearly the big service companies are not doing the kind of revenue generation that they would like to be doing. That's a function of lack of activity, can't be anything else. The rig index is up, but it's nowhere near where its peak is. So yes, I think we will see incremental increase in shale oil production, but it will be incremental. It's not fundamental.
Okay, so perhaps Kate, then back to you on the OPEC front. Nothing to be worried about. We had Mazrui, His Excellency Mazrui yesterday saying, everyone just calm down, you know, everything's fine, we've got plenty of supply. But let me just go back to you, Kate, on that point of the other members of OPEC who aren't meeting their quotas and haven't been. And also let's add Iran into the bucket, which obviously isn't part of the current agreement for obvious reasons. And where are we with Iran on that front? We're obviously got talks coming up. There's an article in our bulletin saying there's been behind the scenes talks of some semi-deal. You know, is there more confidence that we'll see Iranian oil sooner next year than we were?
I wouldn't think so. I mean, what they're talking about now is some kind of interim deal. But let me just, you know, before we move on the US, I mean, if anybody listened to the Senate Energy Committee hearing the other day on high oil prices, you would think that Biden was responsible for everything that's gone wrong in Europe, in Asia, you know, with high oil prices. And he's under attack, you know, and this is a bipartisan committee. And basically what they were saying is, why are you asking OPEC for more production? You know, we've got production here. You've blocked pipelines. You know, you wanted to stop these leases. So of course, this one went ahead because there was a court ruling overturning a ban. So yes, the ban on federal land. So there's a lot of anger because gasoline prices are high, not, you know, as high as they are in Europe because of taxation, but they're still relatively high. And they're saying, you know, this is hitting, you know, the poorer sections of society. So there's a lot of anger, and he's under a lot of pressure. But again, calling on China, which isn't really his place, to call on China and Japan and others to release from strategic stocks. I mean, these stocks, even if you reduce them, you still have to replenish them. So you're not really doing very much. So to go back to the OPEC, and if you look at the numbers, and if you look at the shipping, the latest numbers, even Kuwait is struggling to meet its quota. You know, Kuwait used to be one of the big producers, and it's sort of gone down the rankings. So Iran, I think, no, it's sort of, they're talking about an interim deal, but if you look at Iranian declarations from officials, they want sanctions lifted first. That's not going to happen. So I think you're still at a point where the negotiations are going to drag on. If, you know, they're supposed to start on the 29th, they're not direct negotiations with the Americans. It will be a staged, even if sanctions are lifted, it'll be a staged removal, maybe some show of goodwill. And obviously at this point, it's more urgent to get more oil on the market. So they might move, but not as fast as people know.
Andy, what about the gas situation now? Obviously, we've seen oil's support in the last few months has been partially because of the demand for gas, the lack of supply there, etc. That's pushed the conversion, if you like, or people switching to oil. Where are we with gas prices? They seem to they went down a bit, but they still seem to be pretty firm as we go into winter. Again, where are the worries there? We've just seen. Obviously, in terms of the context of Asian demand as well. So where do you see that going?
So I think you can make a logical argument that says historically on a like-for-like basis, gas has always been undervalued basis oil. So if you take that argument and then look forward and you look at it in the context of the energy transition, then clearly gas needs to become a lot more expensive. And I think we're starting to see the first signs of that, and it's been exacerbated with some of the supply issues and the politics around approving gas pipelines or not, which technically don't really have much impact in the immediate short term. But I think it creates for gas an energy around gas prices are going to go higher, and therefore they should be higher now.
What about the whole argument of spot versus contract deals? You know, the whole, obviously Russia's trying to push more people into taking up more and more long-term contracts, and then the spot market's obviously been suffering. Do we see any sort of trend that's going to change on that front? More people trying to secure their gas given what's happened this year?
So I see a long-term and a short-term perspective. On the short term, you're always going to try and get somebody to take a long-term gas position because essentially it's much more difficult to stop and start. Especially when you look at things like LPG, it's virtually impossible to stop and start. So long-term, high-priced contracts, great for the supplier. But for the market, ultimately, you're going to have to move to much more of a spot business, because that's how the market can then react. I mean, historically, if you look at it, gas goes into markets in a fairly consistent way. So it is matched to the contracts. the oil market has been very different because you can have a refinery go up, a refinery go down, and supply and demand for products changes and crude changes. So you have to be able to be much more kind of flexible and reactive. So I would expect that in the short term, yes, especially with gas prices where they are, producers are going to want to put long-term contracts in place. But over time, we have to recognize that the market's going to need more participants, and we'll have to have a bigger proportion of spot business.
James, let's look at demand and sort of projections for next year. Obviously, demand revisions in the global economy have changed a little bit in the last 3-4 months. Looking at Asia, looking at China in particular, we just saw Gulf producers hike prices into Asia again, very confident that demand will be there at those prices. China's taken a bit of a beating recently. Would you agree? And where are we headed with that confidence in demand for next year?
Again, if I pick up on Andy's word for the morning of uncertainty, I think there's great uncertainty there. I think if you take a look at the changing supply dynamic into China, Russia has slowly crept up until it's now almost equal with Saudi in terms of supplying into China. So clearly there's a bit of a who gets to supply into that Asian market. As you quite rightly say, OSPs have been stronger into the Asian market. So all of the suppliers are feeling like that continues to be a strong market, but market share is going to be key. China has got its issues. It's got its domestic issues, whether you look at the property market situation, or whether you look at the fact that supply of manufactured goods is now outstripping demand for that. And what does that mean in terms of fall-off activity in manufacturing? So, there is uncertainty in that market. I think we'll continue to see the supply players trying to work out who gets to supply, and I think we'll continue to see strong supply prices into that market because it continues to be seen as the market which can bounce back quickest if it gets the chance.
I mean, you mentioned China's issues that it has at the moment, with its financial sector and with its property sector, the Evergrande one being an example. And is there a lot of nervousness around that's going to get much, December is a big month, they're going to have to pay back some of these loans, and lenders, of course, are across the globe. And even Janet Yellen yesterday was saying, this could have obviously serious ramifications across to the US, obviously, when all this continues to unravel. How nervous are markets in general? We're going beyond, but how nervous are they?
Markets are clearly watching it, Diala. I mean, there is a huge amount of banking activity, both domestic and international banking activity, that underpins that property market. There is also a very high proportion of unsold property in China right now. And clearly the property market is a major foundation of the Chinese economy. So I don't think that story is fully played out yet. The Evergrande situation seems to be finding a leveling, but what about all the other players that have been supplying into that market? Is there going to be an unwinding in that? The markets are pushing past that just now, but it's another area of noise which could come back to bite the markets. I think for me, the whole question of the oil markets is going forward in the longer term is who will get to be the suppliers, and against a COP26 environment where we're clearly on a pathway to energy transition. We're clearly on a pathway to much greater rigor around the financial markets supplying capital for developers to develop oil and gas. The questions remain: who will be allowed to produce? Will it be the national oil companies rather than the super majors? And how will they build their supply relationships into Southeast Asia?
Kate, let's go back to demand and talk about Europe, the UK, and the continent. There's a bit of concern, obviously, on these COVID headlines are resurfacing again in various capitals, various countries, restrictions coming back. What's the sort of sentiment there on how immediately that could impact activity, obviously, and therefore energy demand on the street? Well,
I mean, everybody says if you're going to get a cold winter, then we're going to see electricity prices going up again, and coal is displacing gas. Again, if you listen to that hearing in the States, the US is now exporting some coal to Europe, but there's only a limited amount. I mean, one of the people who was testifying at the hearing was the chief economist of the IEA, and he was basically saying, actually, the countries that did best are the ones that have invested in renewables. So it's the Scandinavian countries, the Northern European countries that have fared a lot better, where you haven't seen these price increases. But, the sort of the resurgence of COVID is now they're talking about possible lockdowns in the UK over Christmas, which is mad. But, it's also different policies in different countries. I was in France, you walk into a restaurant, you've got to show your vaccination certificate. Here, you walk into anywhere, you're not supposed to, you don't have to wear a mask, you don't have to show proof of vaccination. But, cases were on the way down, now they're on the way up. You've got Austria imposing lockdowns on unvaccinated people. So I think it's, the vaccination drive seems to have slowed a little bit. There's more anti-vaxxers. So I think it's, again, that's all boils down to the uncertainty of demand growth. And of course, if gas prices are still high, you might get more oil switching. So I think the two are related. You're getting a sort of commodity price increase and everything is being lifted up.
You've got the demand tempering it. Andy, talking about planning, and let's talk about the airline industry, which obviously is a big consumer of jet fuel. And there was talk just about a month ago, and everything was looking very positive, and Asia was opening up, that they were all hedging, on their jet fuel, and anticipating a lot of demand that would continue to increase. Now, where's jet fuel at today, and how can suppliers and consumers and producers sort of plan for that with all this uncertainty?
You just used my word, which James attributed to me, uncertain, and that's the challenge, right? So I think if you go back a few months, everybody was actually feeling quite positive. COVID numbers were coming down, vaccination rates were going up, etc., etc. And then you start to see, actually, it's a lot more complicated. I mean, I think the reality is that we have to start to recognize that this is a global problem. And just because you can have one country that's 100% vaccinated doesn't mean the problem's gone away. You need to have, for jet really to come back, you need two things to happen. You need to have people who are willing to go away on holiday. That's the foundation. Not really making much money out of it, but that's the foundation. And if you've got to do COVID test after COVID test and possible quarantines, and you don't know what's going to happen when you get there, people are going to go, why am I going to go overseas? I'll just stay at home and do something. The second thing is business travel really needs to come back. That's where the airlines make their money. If business travel doesn't come back, then they're not going to make any money. Therefore, actually, they're not going to be putting prices out there to encourage people to go on holiday. So you see what's going on in this region, and certainly Dubai and Abu Dhabi are both very, very strongly pushing on how do we get our fundamental business model back up and running. The air show, ADIPEC, all of those things encouraging people to come here, which is good, but you still need to have the ability or willingness of people to travel.
Yeah, that's a one-off, obviously. Not one-off, but it's Dubai, really. It's very, very concentrated.
Exactly.
As you said, we're open, we've got 100 things going on, and the rest of the world really isn't yet. James, just to touch base a bit on your thoughts on COP26 that ended last week. Two things was the absence of, oil producers there and companies. IOCs were not made welcome. I'm sure there were some there, but again, it was like, well, we don't want you here. Was that a bit short-sighted? And secondly, what are your thoughts on the whole coal argument? It's of phasing it down rather than phasing it out. Was that a surprise?
No, it wasn't a surprise. I'll come back to that in a second. In terms of oil companies not being made welcome, I think that it's the underlying aspect of what is the message that is being sent by that I think we just should constantly reflect on. And I'm not going to that; it would take all morning. But the reality is we find ourselves in a position where the industry continues to be demonized, and there are consequences that come from that. As it happens, I did read at one point in one of the articles that one of the environmental organizations had done a trawl and found that oil company representatives at COP26 outnumbered any of the agencies, or indeed any of the international countries. So there was a real sort of sense of the foxes in the chicken coop, which was being projected. For me, the coal piece, I think I would draw the listeners' attention to a very impassioned response that was made on Monday by Narendra Taneja when he responded to a question positioned by Sean around India and China's response at the closeout on COP. And I've actually subsequently played that podcast to my wife and my children. I said, look, if you want to have an understanding of why that happened at the end of COP and why certain countries are taking a position on coal that seems counterproductive to the global ambitions of the world around the environment, listen to this. And it really is something which I would suggest that the listeners pull down on your podcast and listen to it. It's a very good thing. The reality is...
And that point was that countries like India and China have no choice but to continue supplying their populations with energy. Now, yes, we're moving to transition, but we cannot switch off, these coal mines overnight. Otherwise we're going to have obviously more poverty on the streets, etc.
Correct.
Do you think that And I mean, the industry is listening because they are making those changes. And do you think the argument for being a little bit more patient with the transition has strengthened now, i.e. the next decade, we still need a lot of fossil fuels?
Yes,
do you think that's something thinking in? What do we need to do for that?
Yes, I think one of your speakers sort of paraphrased the output of COP26 as, how will we get there? And the tone of that was, oil demand is back to 100 million barrels per day of oil equivalent. That's not going anywhere in the course of the next 5 to 10 years other than up. So clearly the industry needs to supply into that market. There remains the point which I keep making to you, Diala, which is who will produce that hydrocarbon? And that is a huge question going forward in terms of the next decade. Clearly, a very, very strong position for the Middle East in that particular story. But the reality is that Kate made a very important point earlier on about the political lobbying in the United States, and it's exactly the same in the rest of the world. How will the poor access economic security going forward over the course of the next decade in a world where we don't yet have the technology to replace fossil fuels with renewables or low carbon tech? We're on a pathway to get there, that's for sure. The financial sector is driving the way forward in terms of access to capital for energy-related projects, whether that's fossil fuels, renewables or low carbon, but we are still a long way away from having a balanced energy supply portfolio.
I mean, Kate, on that point of the finance sector driving, and obviously putting shareholders, holding them to account more on their policies and what they're doing, do you see that really becoming a reality in the next 5 years? And how's that going to affect the investment calls that are being made on the industry at the same time? You've got to continue to invest in fossil fuels to keep what you've got going, to find a few new wells, etc. And at the same time, they're holding them to account that they must transition. So, what do you do if you're an IOC?
Well, I think, IOCs are under pressure, so they have to comply with ESG, requirements if they want to access to finance. But, the national oil companies are going to come under similar pressure, because even if, they have, if you're going to be supplying a region where you're going to have higher border taxes on high carbon content, you will find that some some producers like Saudi Arabia, UAE, which have low carbon content. But the thing is, you've got this net zero drive, and people think net zero means zero carbon. It's not. It's not the carbon. It's what you do with the carbon. It's, carbon capture and sequestration. If you want to prolong the life of oil, but also you have to convince the consumer somebody has to pay for it. And ESG is going to make it more expensive.
Andy, on that point of clean fuels, we held a hydrogen workshop earlier this week. As obviously one of the new fuels, green hydrogen at least, being invested into. A lot of partnerships in this part of the world being announced in the last 12 months on that. But the big point was that you have to have an off-taker. That's got to be secured first. And so on that front, on that point of transition, whether it's hydrogen or using CCUS for cleaning fuels, do you think that there is the demand side is secure enough? Is there enough from industrials and consumers to kind of push that forward?
I think that is the crux of the issue, right? So there is no clear path to deliver the environmental promises that the governments have made. You look at some of the fundamentals. I mean, I was at Africa Oil Week, and Woodmac did a really good presentation. And their comment was, if you want to get to where we need to get to, then the demand for oil specifically has to go down by 60% in the next 10 years. And it needs to start today. But we've just heard, it's going to be around for the next 5 years. So we've got this fundamental disconnect between what people want to do and what people can do. So the reality is, we all need to take a big step backwards and say, how are we actually going to do this? Because at the moment, we're not going where we need to go.
Okay, we just see that poll results up there. Will OPEC misinterpret? This is what we started with Kate. Are they misinterpreting where US shale is going? That's very, very close. Obviously, yes, no, so that doesn't really guide us either way, but it certainly shows that there's not full confidence that OPEC is calculating accurately. I'm afraid we've run out of time already, so I want to thank Kate Durian, Andy Lavan, and James McCallum for joining us this morning. Thank you to our viewers, and have a great remainder of the week.
It's a pleasure,
Thank you.
Great to see
Andy,
you.
Kate, nice to see you. Bye-bye.
Nice to see you.